Hi, this is Adam Khoo here, and in this video I'll be talking about the 5 costly mistakes that most retail investors make that's costing them millions of dollars of potentially lost profits. But before that, let's do a quick review on what's happening in the markets. So if you've been following me on YouTube, about a month ago, I called the potential bottom of the bear market and the start of the bull market. So since then, as you can see, the S&P 500 is up about 33% from that low, and it's been really profitable for those of us who have been buying stocks in the last 1 month. My personal portfolio alone, one of them is up over $250,000 just in the last 30 days. All right, this is one of them. As you can see that all the stocks that I have are now showing profits since I entered them about a month or so ago. And it's also really great to know that all my students who have been following me on my private community, my Telegram chat groups, have also been doing really well. Like this guy, Yogesh from Canada, he said, Adam, with the market just partially beginning to rally, my portfolio has gained $19,000 as I write. I took your courses back in December 2019. I've made much more than I paid for the courses, and this gain is without implementing even any of the option strategies yet. Right? Thank you for your selfless guidance. Not only have I learned how to make money diligently, but many other essential things of life as a bonus. This guy Ronnie said, had I not belonged to this group, I could have screwed up big time. I just wish I enrolled in the course earlier. Like most other investors, they missed this rally. They sold at the bottom, and now it's too late for them to get back in again, right? And then you have got this guy, Eduardo. He said, by the way, I'm also like to personally thank Adam and his teachings. Year to date, I'm up 33%, even after going down almost 40% during the COVID-19 hit on my portfolio, right? So very, very quick recovery. This guy, Francesco, you can see his results since the beginning of the year, right? You can see he was hit in March, down 6%, but up every single month before and after that, and he's up 21.88% year to date, and that's fantastic, right? This guy, one of my younger students, Adrian, all right, I blocked his name because I don't want you to harass him, right? He said, thank you for the content you provide. I'm now 19 years old. You changed the rest of my life. I used to trade options on the short term or mid caps, which was already profitable, but combining value momentum investing with my strategy has been the most powerful tool I've used up to now, right? He's up so far $25,000 on his portfolio. Now, the sad thing is that many retail investors may have missed out on this fantastic rally in the last 30 days. Why? Because many retail investors would have sold somewhere here from the fear that's going to go lower, right? You're reading all these negative news headlines. The depression is coming. The market's going to crash as bad as the financial crisis. So the moment they sell, what happens? The market goes up. Right? Now, do they get in? Now, do they buy it back straight away? No. Why? Because they keep reading that there's going to be another crash, right? They say, I'll buy it back when it goes lower, right? And it goes up. I'll buy it back when it goes low, when it goes low, when it goes low, when it goes lower. It never goes low. It keeps going up. Next thing you know, the market's up, 300%, and they're left behind again. It's kind of like those people who are waiting for the aliens to arrive. They may never arrive. Or people waiting for the second coming of Christ. You never know when he's going to come back. Now, the sad thing is that many retail investors would have missed out on this fantastic rally in the last 30 days. Why? Because many retail investors would have sold somewhere here, right at the bottom, because they're reading all these negative news headlines that's telling them people are losing their jobs, businesses are going bust, it's the Great Depression all over again, it's going to get worse, and they sell in panic. The moment they sell, what happens? The market goes up, right? And do they buy it back? No, because they keep hearing from the news that it's going to go lower, it's going to crash lower. So they say to themselves, I'll buy it when it goes lower. And sure enough, it doesn't go lower, it goes up. It's going to go lower, it's going to go lower, it's going to go lower, it's going to go lower. And guess what? It may never go lower. And the next thing you know, the market's up 300%, then you bull market and they're left behind again. It's kind of like those people who are waiting for the aliens to arrive. They may never arrive, and you keep waiting and waiting and waiting. Or people who are waiting for the second coming of Christ. You have no idea when it's going to come. So get on with your life first. And I can tell you that as a retail investor, you can make tremendous profits investing in the stock market and watch your wealth compound and grow over time. The reason most people don't achieve that is because they keep making the 5 costly mistakes. And once you understand these mistakes and you rectify these mistakes, you can turn around your financial future. So let's run through these mistakes right now. Mistake number 1. The most common mistake retail investors make is that they sell stocks when a recession starts. They anticipate where the stock market is going to go by watching the economic news. And you can't do that. Why? Because always remember this. The stock market is not the economy. They are two totally different animals. The stock market is a leading indicator of the economy. The stock market doesn't care what the economy is doing now or next week or next month. The stock market always anticipates what's going to happen in the future. So take a look at this chart, which I've shown before in my previous lessons. This red line that you see here is the stock market cycle, right? So over here you can see this is the top of the stock market, market top, and this is the market bottom. Now obviously as an investor, when do you want to buy? You want to buy the market bottom and sell at a market top, correct? Buy low, sell high. But notice something interesting. The green line represents the economic cycle, and the economic cycle moves very differently. Can you see that when the stock market is at the bottom here, what's happening to the economy? That's right, the economy, the green line, is going into a recession. That's right. So the time to buy stocks is at the market bottom when the economy is going into a recession. So you don't sell stocks when a recession starts. You buy stocks when the recession starts. And when the recession is in a full recession, you buy even more stocks, all right? Now, the trouble with most investors is they do the opposite. What do? They sell when the recession starts. And by doing that, you're selling at the market bottom. Or during early recession, when you're selling near the bottom. Okay, and that's why most investors sell low. Okay, now when do most retail investors buy? They buy when the economy is doing well. All right, now notice what's happening. When the economy, the green line, starts to recover, when the economy recovers and investors say, okay, I'm going to buy stocks, what's happening? They are buying right at the market top. And so they always buy at the top and they sell at the low. And that's why they always lose money. Now, let's watch this theory play out in real life. And these are the most recent economic news. So again, take a look on the 26th of March. What was the economic news? Jobless claims soar past 3 million to a record high. 30th of March, coronavirus job losses could total 47 million. Unemployment rate may hit 32% unemployment rate in the US, right? 9th of April, IMF chief says pandemic will unleash the worst recession since the Great Depression. So all this tells us the economy is in shit. The economy is in big trouble. So what do you think most retail investors do? They sell, right? So now you know what should you do as a professional smart investor. You buy stocks when you see negative economic news, because when you see this negative economic news, it means the market has bottomed, right? And sure enough, take a look at the charts. 26th March, 30th March, and 9th of April. There you go. 26th March, 30th March, and 9th of April. That's when the market bottoms and the bull market begins. So I was buying stocks with all my students when retail investors were selling stocks. You do the opposite of what everyone else does. And sure enough, you can see another good example of how the stock market is not the economy. On the day where there's a record 20 million jobs lost, unemployment rate jumps 14%. What happens to the market? The market rallies strongly on this day. Now, I've been investing in the markets for 27 years. I have been through 7 bear markets. And let me tell you something, the movie plot is always the same. Let me show you the last time this happened, right? On the 3rd of April 2009, here's what the news headline said. 663,000 jobs lost in March alone. Total jobs lost 5 million. On the 8th of May 2009, the news said this: global economic shock worse than the Great Depression. So what do you think most retail investors do when they read these news articles? That's right, they sell. But now you're smarter, what should you do? You buy. That's right. Now let's see what happened if you bought on the 8th of May, on the 3rd of April. Check it out. On the 3rd of April, if you started buying, on the 8th of May, if you started buying, guess what? You would have caught the strongest bull market in history. From there, the market went up 380% over the next 10 years. So once again, economic news bad, recession hits, we buy stocks because that tells us the market is bottom. Let's go back even further and watch previous movies, right? All right, so let's take a look at the news headlines back in 2002 to 2003. First headline, US retail sales fell 1.2% in September, more indications of a slowing economy. 12 October 2002. Next headline, Fed gets gloomier on the state of the economy. Activity sluggish, survey discovers 24th October 2002. Next headline, dismal 2002 ends quietly on Wall Street. Dow's percentage loss biggest since 1977, 1st January 2003. And finally, Dow retreats below 8,000 points. War, other fears spur bearish sentiment. 28 January 2003. All right, so you know the plot of the movie. You've seen it many times before. Tell me, what should you do? Should you buy or sell? And the answer is, when you look at negative headlines, you buy. That's right. What happened after this? 2 months later, the market started a bull run for 4 straight years and gained 86%. Okay, let's play again. News headlines in 1974, the year I was born. Economy in recession, Citibank report says 23rd July 1974. Next headline. Financial leaders feel anxiety about the future of the economy, 4th August 1974. Next headline, Dow Jones average hits 12-year low, 28 September 1974. Finally, 68% of people surveyed see the economy worsening, 29 September 1974. Again, you've seen this movie many times before. You know the plot. Buy or sell? The answer is buy. That's right. A month later, you'll be pretty happy because 1 month later, the market started a bull run for 13 straight years and gained 514%. So you can see again, the movie keeps repeating itself again and again every number of years. So let's summarize lesson number 1 that we've learned. Lesson 1, stocks are near the bottom when the economy goes into a recession. So whenever you see recessionary headlines, economy is getting worse, it's time to get bullish, it's time to buy stocks. But before buying stocks, I always wait for the technical analysis to confirm the reversal. I've explained this in previous videos. For example, I look at the oversold conditions on the Williams percentage R, or extreme volatility from the normalized indicator, or I see a change in the moving averages. So never predict the reversal or predict the bottom. Always wait for the technical charts to confirm the reversal. And these are covered in my advanced technical analysis training in the stock trading course. The other thing to be cautious about is when I say buy stocks, I don't mean buy all the stocks because there are good stocks and there are lousy stocks. I mean buy the index because the index always goes up in the long run, like the S&P 500 index or the Dow Jones Index ETF. Or you buy high quality companies that have got strong balance sheets and strong earnings. And these are the things that you learn in the Value Momentum Investing course, where I teach you how to find high quality companies. Please avoid lousy companies with weak earnings and weak balance sheets because you buy these stocks, they will not recover. All right, so that's the first thing. Number 2, conversely, when the economy has fully recovered and you read all kinds of good economic news, right? They say economy is doing well, people are getting jobs, low unemployment rates, be careful. That means that stocks are near the top. So time to get cautious, time to start selling some of your stocks that are way overvalued, right? Or you can buy put options like what I do to profit when the market begins to reverse into a correction. Now here's the thing, you can't always predict the exact top. No one knows the exact top. So I always wait for the charts to confirm the reversals. Again, looking at the moving averages or the price action. Again, let's take a look at some real examples right now. So these were the news headlines in 2007. Let's play a game, all right? Ready? Headline number 1, job growth strengthens economy, spending and hiring rise while inflation eases. 2nd June 2007. Next headline, what does it say? S&P 500 tops 1,500 points on strong earnings. Index approaches its all-time high, 4th May 2007. Next headline, economy manufacturing grows, 2nd May 2007. Finally, rise in factory orders propels Dow Jones to new highs, 3rd May 2007. Great economic news, right? So bullish or bearish, should we buy or sell? Well, here's what happened, right? 3 months later, the financial crisis erupted and the stock market plunges 55% in 12 months. There we go. So like I said, now just because you read good economic news does not mean you sell immediately. It does not mean you short the markets, because you can't predict exactly when it's going to happen, right? Is it going to happen 1 month, 2 months, 3 months? No one can predict. So always wait for the charts to confirm the reversal. So in this particular case, you can see that the reversal from the bull market to the bear market was nicely confirmed by the moving averages, right? Where the 50 moving average crosses below the 150 moving average, right? The blue line crossing below the green line and both moving averages sloping down. That is a technical reversal pattern, right? At the same time, you can also see the price action where the market makes a high, lower high, lower high, lower high. When it makes 4 lower highs in a row, it's also a change in trend signal. So that would be a time to sell stocks, to short the market, or buy put options to protect your portfolio. So this is costly mistake number 1. There are 4 more mistakes to go, and I'll cover them in part 2 of this video. So stand by for part 2 and I'll see you soon. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com, where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses, where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.